Hello everybody, welcome to another video on section 1 of my videos. Today we're going to be discussing the type of trader that you need to choose to become, right? This is very important because it will determine what timeframes you're looking at, how you're trading, what times you're trading, etc. And it's very important to just kind of get this out of the way before you actually start trading in general. If you pick a title, then you are able to stick with that and you can back test, stress test and trade within those time frames, right? Now, there's a few things you need to keep in mind with this, kind of just dedicated to yourself, right? If you're somebody who has all the time in the world to be at the charts, you don't have a full-time job, you're able to be on your laptop or your monitor, whatever it is, all day long. You basically have free reign of what type of trader you want to be. You can be a position, swing, intraday major, intraday minor, or a scalp trader, right? It's completely down to you because you have all the time of day to choose the times that you want to trade, right? You can monitor your trades. Say if you're a scalp trader, if you've traded on the M1 and you're targeting, say, an M5 high, for example, and you're focusing on the micro moves of the market, you're able to look at the chart anytime within session and monitor and trade it, and adjust it how you want. Whereas if you're somebody who's working a full-time job, let's say in England, you're working, say, 9 to 5, and with the commute, that's about 7:30 to about 6 p.m., you don't really have free reign, right? And especially if you have a job that requires full attention the whole day, you can't go on your computer to analyze, and I'd really recommend you don't get in the habit of trading on your phone. That is a very disastrous habit, in my opinion, because you don't have the full picture of things. Obviously, you can't very well analyze with your fingers clicking on the screen. It's much easier to do it on a computer, but you're not able to perhaps be a scalp trader in that realm of things because you can't look at the charts every minute or every second of the day, right? So I would, just kind of take that into account. Just be mindful of your current situation, whether that's going to change in, say, 6 months or a year or 2 years. You want to be focusing on your situation now because you never know what the future holds. It could change, it could stay like that for a while, and you want to just kind of get in the habit of trading in the right way, which is suited to your situation, right? So I'll walk you through each one. So obviously position trader, as you can see here, the trade duration can be from a few weeks to even a few months or even a year. I mean, it depends how long you want to trade. And you want to choose a broker that doesn't charge swap on your trades because you'll be losing out a hell of a lot of profit based on swap if you're holding out for a few weeks. And you can do your research on what type of brokers don't charge swap. Usually Islamic concept offerings from brokers, they don't charge swap because it is against the Islamic concept. So that might be an option that you want to go with. Swing trader will be a few days up to a week, and your time frames will be your daily, your H4, your H1. You'll typically execute on your H4 and your H1s, and your daily will be more for kind of like your longer term analysis, and these will be kind of for your externals and internals within the daily time frame. You have to remember as well that all time frames are fragments of data in different realms. So basically, if you're looking at say you're looking at the monthly chart, right, you're seeing the exact same data, just more of it on, say, the daily or the hourly or the 15-minute or the 1-minute. It's all just the same data, but it's a lot more kind of it's a lot more detailed as you go lower, right? You see a lot more happening, so you need to be mindful of that, obviously, as well, right? Intraday trader, if you're looking to be obviously a major intraday trader, you don't want to be executing on anything lower than the M15. It's very similar to the minor, obviously, just on the M5 would be your kind of lowest point of time frame analysis, and you'd more than likely be executing on the M5 or the M15, right? So you'd be looking at these time frames. Obviously, these aren't exact; they are just guides, but this is roughly what you'll be looking at as an intraday trader. As a major intraday trader, your trade duration will be around 4 hours up to a day, and your minor will be under 4 hours, right? It'll be probably about an hour to 4 hours. It could stretch to maybe 12. Obviously, it just end of session, say from London to end of New York, that's typically what you'd be looking at as a maximum. And then a scalp trader can be a few minutes or even a few seconds, depending on the trade, to an hour, maybe a couple hours as well, right? And you'll be looking at the M30, so the 30-minute time frame, the M5 or the M1, right? And you'll be executing on these lower time frames here to get those micro moves, right? So they are the type of traders, and like I said before, based on your situation, you need to select one that is suited to that, and you can stick by that and get to know the timeframes that you should typically be looking at and trading on as well, right? Because I can tell you from experience, a swing trader and a swing trading style is very, very, very different to a scalp trading style, right? Scalp trading style, you'll be able to capitalize 2% in a matter of minutes, and as a swing trader, this could take up to a few days, right, to get 2%. Doesn't mean one is better than the other, because you can lose 2% as quickly as you can make 2%, if not quicker as a scalp trader, right? And you have, I guess, more breathing room as a swing trader, and you won't be losing this amount that quickly in that essence, right? So it's all just down to you, and it's also down not just to your situation, but also your risk tolerance, your patience. You know, what everyone's patience tolerance and risk tolerance is different. You just have to figure out what works for you, right? So I really urge and stress this. It's very important before we get onto anything. And I'd like to also mention as well, regardless of what you pick, the concepts do work on all these timeframes, whether that's structure, whether that's things like sponsored candles, inefficiencies, wicks, etc. And the models also do work on every single one of these timeframes, right? So you're not missing out if you say pick swing, or you're not missing out if you pick scalp. Personally, I fit within the realm of the minor intraday to scalp because this is my full-time gig. So I'm able to be at the charts kind of all the time, and my selected hours personally are between 8 a.m. and 12 p.m. and then I'll maybe miss out 1 or 2 p.m. and then I will go to maybe 3 to 4 p.m. if there's an opportunity there. I'll execute there. Sometimes I'll be on all day, and sometimes I'll be finished by London, or sometimes I won't even trade London and I'll just go straight in at around 12 and then finish about 4, right? So it's all just dependent on the day, what sets up, what's my schedule like. But I can, and I have the ability to do that. And ideally, I want to be out of the trade kind of within an hour, maybe even sometimes in a few minutes, because you do get the odd trade that, say if I'm in a buy right here, you do get the odd trade that just goes straight to your TP and it's perfect. But sometimes it can last until the end of the session and then I get the TP there. So typically that's what I look for. Just easier to manage in my opinion. I don't want to be waiting kind of like 3 days for 2%. If I can hit my monthly target, which is 5%, and that's standard, then I am happy, right? And another thing I also want to stress as well is setting a monthly target, in my opinion, is very vital, right? Because when it comes to trading, it's very easy to be in profit and then think to yourself, and I've had this many, many times, and I'm sure those of you that have been trading for a while have also had this thought process many times, is that when you're in profit, you feel like you have the free reins to just trade, and that can just backfire consistently, right? Because technically you're not losing any of your money. Let's assume that you've put into a trading account, say £10,000 or $10,000, you've made 5%, right? And you're up, say, $500 or £500. You're like, well, that's not my money, that's the house's money. I can trade with that. If I make more, great. If not, well, I don't lose anything, right? You don't want to do that because that is a very destructive mindset. It also kills the compounding effects as well of your account. If you can easily hit 5% a month consistently, and that's of your previous month's balance. So month 2 would be 10,500. That's supposed to be a 0, by the way. 5% of this will be more than £500, right? From the typical 5% of 10K, which would be your original, right? So what I'm trying to say is once you hit this monthly target, stop trading completely, right? For the rest of the month. But I wouldn't say stop trading on a demo account, because if you are consistently in your flow and you're consistently trading, then you don't kind of lose your edge. I find that sometimes when I go on holiday for a week or a couple of weeks and I don't trade, I do sometimes fall back a bit in my first few weeks of coming back. And that's normal because you kind of come out of your flow. That's normal with most things, right? If you, say if you work just a standard job and you're doing something consistently every single day, day in, day out, 5 days a week, 6 days a week, whatever it is, then you go on holiday, stop for 2 weeks, the first couple of days or even week when you come back, you're probably going to be a bit iffy with it. So don't worry about that, right? But 5% is I think is a good kind of like target to have, because if you think about this on a like a massive account, let's say from $250,000, 250,000 or even 200,000, I know that's the standard prop firm issuance as their highest account. 5% on that is £10,000, right? $10,000, whatever currency you're trading in, right? Which is brilliant. And if you can compound that for over a year, that's massive, right? That's really, really good. You know, it's verging near 100% a year if that's compounded, obviously, right? So that's just something I want to say, regardless of what trader you are and regardless of what percentage you pick, you do need to get out of your head as well, because I've noticed that a lot of people that have been within this space, but they're not super experienced with these concepts, is that they think that high risk to reward, right? So, you know, your 1 to 10s, 1 to 20s, etc., is better than win rate, right? A lot of people think this, and I think this is completely wrong. I think it's the other way around. Your win rate is far more important than your high risk to reward, right? Because if you take, just going to get rid of this now, but if you take, say, high risk to reward, let's do high RR, over your win rate, and let's say you're targeting 1 to 10s minimum, right? Which are possible to hit, by the way. They're just not as easy as your 1 to 2s, right? And your win rate's going to probably be sitting at around 20% if you're really good at it, right? But let's say, for example, you take 10 trades, right, and you lose 8 in a row, right? So let's say with £10,000, you know, you've done minus 8%, so you've risked 1% of your initial balance every single time, right? Regardless of if it's gone down or up. You'll be at, I think I said 10,000, so you'll be at 9,200, right? And then you take another one, and then you lose again, so you'll be at 9,100. First of all, are you going to be willing to risk another 1% of this, right? Are you even going to be in the frame of mind to try and reach this again? Second of all, 1 to 10 trades, right? So let's say we have risk to reward tool here. This 1 to 10 on TradingView near enough always fails to actually equal 10% profit. And this is because of simple things like spreads, slippage, you know, you've potentially under-risked, you know, so you're potentially risking 0.8%. You know, you might take partials, you might move your stop loss a bit, and you might say maybe only come out with, say, 7% instead of your 10% that you have on your TradingView thing here, right? So you're more than likely not going to be in profit after that. And because your win rate is so low, this could just potentially just be a never-ending cycle of just going down like that. And not every single trade is going to present 1 to 10, right? So if you're, basically your targets need to be proper. They need to be placed at the correct place, not at just, you know, the high that, so say if you're trading on the M1 over here, right? You're trading on the M1, you're a scalp trader. You're not going to be targeting the daily high, right? Which is, say, was made 3 months ago, and you're basing that off of a small M1 transition, right? To try and get 1 to 30, right? Because that's probably what it would be. That is very, 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 very unrealistic. If you're trading M1, you ideally need to be targeting the next M1 high. Let's say you're in a buy, right? You ideally need to be targeting the next M1 high, which will be over here, or the next M1, say, or M5 POI over here, or M15 maximum. And that's it, right? And that would probably be a 1 to 2, 1 to 3, 1 to 4, 1 to 5 at a push. And if you can make 2 or 3% in a single trade, like, you have to realize how good that is, right? the standard benchmark across all big firms in like the investment industry, right? Their standard benchmark across multiple asset classes, but typically equities, is 8% a year, right? 8% a year. That is less than 1% a month, right? So if you can make 2% a month, you are massively beating this, right? Because 2% a month compounded, that's roughly about, let's just call it 28%, right? Just off the top of my head. So you get an extra 4% on the compound. It's probably a bit more than this, but 28%, right? 28 minus 8% is 20% annually, which is still amazing. And that's 20% alpha, right? I've just done the alpha wrong there. But it's 20% alpha. And if you don't know what alpha is, it's actual return minus the benchmark set. Okay? So that just should give you a little bit of a kind of overview on setting a realistic target, and it needs to be in alignment with the type of trader you are, whether that's position, swing, major or minor intraday, and scalp, right? Doesn't matter what it is. It needs to be in alignment, right? Other than that, guys, that's it for this video. Thank you for watching, and I'll see you all in the next one.